Hey everyone, and welcome. If you're gearing up for your CA exams, you're in exactly the right place. Today, we're going to tackle a really fundamental chapter in cost accounting, accounting systems. We're going to break it all down, piece by piece, focusing on what you absolutely need to know to nail those exam questions. So let's get right into it. All right, let's kick things off with a classic exam curveball, the kind ICAI absolutely loves. So picture this. A transaction says materials purchased on credit. Immediately, everything you've learned in financial accounting is screaming, credit the creditor's account. Easy. But wait, hold that thought. That's a trap, and it could cost you some serious marks. The right answer, and this might surprise you, depends entirely on the accounting system the company uses. And that, my friends, is the whole point of this chapter. Okay, so at the very heart of this topic is one big decision a company has to make. Are we going to keep just one set of books for everything? Or are we going to maintain two completely separate sets of books, one for our financial stuff and another just for our cost accounting? It sounds simple, but this one choice changes everything about how we record transactions and, importantly, whether or not we have to go through the headache of reconciling profits at the end. And here's the difference in a nutshell. Non-integrated means two sets of books, period. You can think of it like having a personal diary and a separate work diary. They track different things, right? And at the end of the month, you'd have to compare them to see the whole picture. That's the reconciliation part. Now, the integrated system is just so much cleaner. One set of books, one final profit number, and absolutely no need for any reconciliation. Simple. All right, let's jump into the deep end. We're going to start with the more complex of the two, the non-integrated system. Now, I know it can look a bit intimidating at first, but seriously, trust me on this. If you can get your head around this system, the integrated one is going to feel like a walk in the park. So let's focus here, because this is where ICAI really loves to ask tricky questions. So what is it really? A non-integrated system just means we have this separate universe, the cost ledger, that's super focused. It only cares about costs that are directly related to making and selling our products. Materials, labor, factory overheads. And this is crucial. Purely financial things like interest income or donations or bad debts, they have no place here. They are completely ignored in the cost books. Within this system, we have a few key players. The cost ledger, that's our main book, the big boss. Then you've got the stores ledger, which is like a detailed inventory list, tracking every single nut and bolt. The work in progress, or WIP ledger, keeps tabs on the costs of all the jobs that are still being worked on. And finally, the finished goods ledger, which, you guessed it, tracks all the products that are ready to be sold. Okay, everybody, lean in, because this is important. This is the secret sauce. To make this whole separate cost ledger system actually work and balance by itself, we use a special tool called control accounts. I'm telling you, understanding these accounts is the absolute key to cracking any non-integrated accounting problem you'll ever see. Now, pay very close attention, because this is where so many students lose marks. The cost ledger control account, sometimes you'll see it called the general ledger adjustment account, is the single most important concept in this whole chapter. Think about it. The cost books don't have an account for creditors or debtors or cash. So this one magic account steps in and acts as a stand-in for all of them. It's the bridge that connects the cost world to the financial world. So besides that main bridge account, we have a whole team of other control accounts. Each one just represents the grand total of its subsidiary ledger. So the stores ledger control account gives you the total value of all your materials. The WIP control account is the total cost of all the unfinished jobs, and so on for finished goods, production overheads, and all the rest. Each one is a summary, controlling one part of the cost flow. All right, enough theory. We've met the key players, these control accounts. Now, let's see them in action. We're going to follow the money, basically. We'll trace the flow of costs all the way from buying raw materials to selling the final product, and we'll do it using journal entries. I promise this is where it all starts to click. Let's start with materials. When we buy materials, we debit the store's ledger control account. Simple enough. But what do we credit? Hey, remember that question from the very beginning? Here's your answer. We credit the cost ledger control account because it's our stand-in for the external party, the creditor. This is a classic ICAI move, so please burn this entry into your brain. When we issue direct material, it goes to WIP. But if it's indirect material, well, that's an overhead, so it goes to the production overhead control account. You see, the logic just follows the flow of cost. And guess what? The logic for labor and other expenses is pretty much identical. See the pattern? Direct wages, that's a direct cost, so we debit it straight to the WIP control account. But indirect wages or other factory expenses, those get debited to their own specific overhead control accounts. And in every single case, because we're paying an external party, the credit always goes to our one-stop shop, the cost ledger control account. Okay, let's talk about overheads.
This is another one of those areas where you can get tripped up. First, we incur the overheads, which we just saw, but then we have to absorb or recover them into our production costs. We do that by debiting WIP and crediting the overhead control account. Now, at the end of the month, the amount we incurred might not perfectly match what we absorbed. That difference is called under or over recovery, and that difference has to be transferred to the costing profit and loss account. It's a classic adjustment in exam problems, so watch out for it.
And now, let's finish the story. Once a job is done, we transfer its total cost out of WIP and into the finished goods control account. When we actually sell that product, the cost moves again, from finished goods to the cost of sales account. Now, to record the sale itself, we debit the cost ledger control account because that represents our customer, the debtor, and we credit our costing P&L. And that final balancing number in our costing P&L, that's our profit or loss, which gets transferred back to the cost ledger control account to make everything balance. The cycle is complete.
And this flowchart right here just ties it all together beautifully. You can literally see the journey. Look how materials, wages, and production overheads all get poured into the work-in-progress control account. From there, the cost moves to finished goods, then to cost of goods sold, and finally cost of sales. This visual is an amazing way to lock the sequence of accounts in your mind.
Whew, okay, deep breath. We made it through the non-integrated system. And now, for the good news, let's talk about the integrated system. This is the modern, much more streamlined way of doing things. It basically takes the single most confusing part of what we just learned and just throws it in the trash.
So what's so great about an integrated system? Well, its features are basically the solutions to all the hassles of the non-integrated one. We've got just one single set of books. That means there's no need for that mysterious cost ledger control account. And the best part? No more painful profit reconciliation, because there's only one profit figure to begin with. It's all about making things efficient and straightforward.
So what is the single biggest change? The one thing you need to remember? That super confusing abstract account we just spent all that time on, the cost ledger control account, in an integrated system, it's gone. It just doesn't exist. It is completely eliminated. And that makes life so much simpler.
So you're probably asking, if that big account is gone, what do we use instead? Well, we use the real accounts, the ones you've known since day one of your accounting studies. When you buy materials on credit now, you just credit the creditors or payables account directly. When you sell something on credit, you just debit the debtors or receivables account. No more stand-ins. You're using the actual, real financial accounts inside one unified system.
Okay, we've looked at both systems now. Let's put them side by side in a final showdown. Think of this as your ultimate revision checklist. It's perfect for those theory questions and for making sure you've really cemented the differences in your mind. This table just lays it all out so clearly. Non-integrated, 2 sets of books. Integrated, just one. One system lives and dies by the cost ledger control account. In the other, it's not even a thing. One needs a mandatory profit reconciliation, the other doesn't. You can bet that ICAI loves asking theory questions based on these exact points. So this table right here is pure gold.
For a second, you're in the middle of a big 16-mark question. You've slogged through it, you've made the financial P&L, you've prepared the cost sheet, you get to the profit figures, and they don't match. One shows 1,10,000, the other 1,35,000. What's that first feeling? Absolute panic, right? But what if I told you that this difference isn't just okay? It's actually supposed to be there. This isn't a mistake. It's where the real question actually begins. So the whole reason we even need to talk about reconciliation is because some companies keep 2 different sets of books. They've got the financial accounts, which are for the outside world, shareholders, the tax man, and then they have cost accounts, which are for their own internal decision-making. This setup is called a non-integrated system. And because these 2 sets of books are made for different reasons with slightly different rules, it's totally normal for their final profit figures to be different. Our job isn't to fix a mistake. It's to explain the difference and prove that both books are actually correct.
Now, if that sounds a bit intimidating, don't you worry, because I guarantee you've already done this exact same thing before. Just think back to your bank reconciliation statement, your BRS. You start with the balance as per your cash book, right? Then you add checks issued but not presented, you subtract deposits not yet cleared, and like magic, you land on the balance as per the bank statement. Well, this is the exact same idea. We just start with one profit, add and subtract all the items that are causing the difference, and we arrive at the other profit. It's really that straightforward. All right, so the million-dollar question is, what exactly are these differences? We have to put on our detective hats here and find these specific items that are causing this disagreement. These are the culprits we're hunting for, and luckily they fall into just a few main categories. First on our list are items that only show up in the financial accounts. Let's talk about expenses. Your financial profit and loss account gets hit with debits for things like interest you pay on a loan, income tax, or maybe a donation the company made. But just think about it. Are any of those things related to the actual cost of making a product? Nope, not at all. So in cost accounting, they're completely ignored. This is one of the biggest reasons for the difference, and it's a place where students often lose marks if they don't spot these items correctly. And this brings us to the golden rule. Just use simple logic. Since the financial accounts have these extra expenses that the cost accounts don't, the financial profit is obviously going to be lower than the cost profit. So if your starting point is the lower financial profit and your goal is to reach the higher cost profit, what do you have to do? You've got to add those expenses back. Simple. And if you start with the cost profit, you just do the opposite and subtract them. Getting this relationship straight in your head is absolutely crucial. Now, let's look at the flip side, purely financial incomes. Your P&L account gets credited with money coming in, like interest you earned on an investment or rent you received from a property the company owns. This is definitely income for the company, but once again, it has absolutely nothing to do with the day-to-day operations of production. So it's in the financial books, but you won't find it anywhere in the cost accounts. And right here is a classic ICAI trap. Pay attention. The logic for income is the exact opposite of the logic for expenses. Because of these extra incomes, the financial profit is now going to be higher than the cost profit. So, to reconcile, if you're starting from the higher financial profit, you have to subtract these income items to get down to the lower cost profit. ICAI absolutely loves to mix financial expenses and financial incomes into the same problem just to see if you can handle this reverse logic. Don't let it catch you out. Okay, what about things that are only in the cost accounts? Well, these have a special name, notional expenses. The word notional just means it's an idea, it's hypothetical. These are costs that the company didn't actually pay any cash for, but the cost accountant includes them anyway to get a truer, more realistic picture of the cost of production, which helps a lot with decision-making. The best way to understand this is with an example. The classic one is rent on a building the company owns. Think about it. If you own the factory, you don't pay rent, so in the financial accounts, the rent expense is zero. But the cost accountant might say, hang on, if we didn't own this building, we would have to pay, say, $50,000 a month in rent. That's a real cost of using this asset. So they'll charge a notional rent of $50,000 in the cost sheet. This gives them a much better idea of the true cost of their product. Another huge reason for profit differences is how inventory is valued. In financial accounts, you have to follow Accounting Standard 2, which says you value stock at cost or net realizable value, whichever is lower. But in the cost accounts, they might just value the finished goods at the total cost of production. So what happens if closing stock is valued higher in the cost accounts? Well, higher closing stock means lower cost of goods sold, which means the cost profit will be higher. It's a subtle point, but it can have a big impact. And finally, we have the two big ones, overheads and depreciation. In costing, overheads are absorbed using a predetermined rate. Keyword there is predetermined. It's an estimate. But in financial accounts, we record the actual overheads that were paid. This almost always creates a difference, which we call either over-absorption or under-absorption. Same story with depreciation. The cost accounts might use a machine hour rate because it makes more sense for production, while financial accounts will use SLM or WDV as the Companies Act tells them to. Different methods, different amounts, different profits. So we've rounded up all our usual suspects. Now, how do we present our findings in the exam? We use something called a reconciliation statement. Think of it as the bridge that perfectly connects the profit from the cost accounts to the profit from the financial accounts. And here's what it looks like. It's super simple. You can start with either profit figure. It really doesn't matter. Let's say you start with the profit as per cost accounts. Then you just make a list of all the things that need to be added and all the things that need to be subtracted based on the rules we just went over. We're literally just taking all those culprits we identified, the financial-only items, the notional costs, the overhead differences, and we're adjusting for their impact one by one. And if you do it right, the number you end up with will match the other profit figure, down to the last rupee. Look, theory is one thing, but marks are earned when you can apply it. So let's take everything we've learned and use it to solve a classic ICAI-style problem right from your study material. Now check this out. This illustration gives you a scenario where the financial books are showing a loss of 3,000 rupees, but the cost books are showing a profit of 20,000.
Now, in an exam, that would be enough to make anyone second-guess their entire paper. But not you, because you know this isn't a mistake. It's just a reconciliation puzzle, and the rules are exactly the same.
So where do we even start? The question gives you a massive hint in the ledger accounts. It tells you the overhead control account has a closing credit balance of $23,000. This is super important. Whenever you see a credit balance in an overhead control account, it means one thing. The overheads you absorbed or charged to production were more than the actual overheads you incurred. In other words, it's over-absorption.
Okay, let's really break down the logic here, because this is where you either gain or lose marks. Over-absorption means the expense in your cost accounts was too high. Let's say you charged $1,023,000 in your cost sheet, but the actual expense was only $1 million. That extra $23,000 of expense in the cost books has made your cost profit artificially lower than it should be. So to fix this and reconcile, you have to start with that lower cost profit and add back the over-absorbed amount. That's the logic, and it never changes.
You know, for those really big, comprehensive problems, reconciliation is the last step of the marathon. You have to build up to it by preparing all the control accounts first. In your store's ledger account, always look out for material returns. For the wages control account, the most common trap is not splitting the direct and indirect labor correctly. And the works overhead account is where you'll find that all-important over or under absorption figure. Get these building blocks right, and the final reconciliation statement is just a simple case of putting the numbers in the right places.
All right, team, let's switch gears and lock all this in with a quick rapid-fire round. This is perfect practice for the MCQs and the theory questions that ICAI always throws in on this topic. You ready? Let's do it. Which of these items would you find in the cost accounts? Let's see. Donations. Nope. Purely financial. Transfer to general reserve. That's an appropriation of profit, also purely financial. Rent receivable. That's a financial income. The only one that is a pure costing concept is, you got it, A, notional rent. Perfect. Okay, a slightly trickier one. What should be added to costing profit to get to financial profit? Let's think this through. Interest paid and income tax are financial expenses. They aren't in costing profit at all. So to get from the higher costing profit to the lower financial profit, we would have to subtract them. What about over-absorption? We just learned that over-absorption makes the costing profit too low. So to bring it back up to where it should be, we have to add it. So the answer is A. And don't forget, you're going to get theory questions too, like this one, which is a favorite. Why do we even need to reconcile? You can't just write a one-liner. You need to give them solid technical points. So here are your magic keywords, your scoring points. Number 1, it helps identify the exact reasons for the difference in profits. Number 2, it acts as a check on the arithmetical accuracy of both sets of books. 3, it makes sure that the cost data we're using for important decisions is reliable. And 4, it helps the finance and production departments to stay on the same page. Write down these points and you are golden.